All right. Good morning, everybody. Green on the screen across the board and around the world. Hong Kong did close down on the day more than 1.5%, but other than them, everything else is green. If we look at the US markets, the small caps are down the most and the NASDAQ is up the most. Then in the middle, you got the Dow and the S&P. So the small caps usually fits into that dash for trash, junk plays, short squeeze, those kind of products. And the NASDAQ, of course, is where we're going to find tech and junior tech, all that good stuff. We got a pretty light morning when we think about what's on the docket today. We get some housing data from the US and from Canada. And then we've got these additional auctions, and we have a few Fed speakers coming out to talk. This week, I believe it's this Friday, we have Jackson Hole. Usually it's not too big of an event. Last year it was when Powell did that mic drop moment where he was supposed to speak for like 8 to 12 minutes or something like that, and he ended up speaking for 30 seconds, and his message resonated around the world and dropped the market a couple hundred points in a very short period of time. That's when he told the market to suck it up because we're going to have higher for longer, and that he wasn't kidding, and down she went. So we're back again. We made another trip, made a year's worth. So now we're looking for Powell to use this as a chance to maybe steer the markets a little bit. In his last FOMC, they took forward guidance off the table. If you remember, what they've been doing for the last few years is they give us a forward projection of their anticipation of the next meeting. That we're going to very likely raise rates. We're not done raising rates, that kind of thing. We're going to raise again. And so everybody really had a solid idea of what the Fed was going to do. And then we started getting into that level where they really needed to announce a pause, but announcing a pause has historical consequences to it. So rather than announcing a pause, they did a skip. And then after that skip, they finally just said, we're not going to discuss what we could get or what we're going to do until we have our meeting and we come out and tell you what we're going to do. So they took it off the table. We've gone through it before, but if you do want to look and see what the market is pricing in, you can Google CME FedWatch tool and you can take a look. Now, this is not some hypothetical, right? They're not guessing or assuming. This isn't a query or some sort of survey. It's looking at trades on the ZQ U Series 2023 contract. And the trades from that run through a little bit of a internal filter, gives us these probabilities, right? So then rather than reading it as a spread, you just pick one of those numbers. So if it says 525 to 550, you could just choose, say, 525. And then look down at the bottom. What is the anticipation for the September 20 FOMC meeting? The anticipation is a pause that at the end of the meeting will still be at 525. And that is sitting at an 88% likelihood. After Jackson Hole, we want to see where this number is at that point, because the market's been pricing in a pause. But if they have to start pricing in a rate hike, this is going to go down. The rate hike is going to go up. That'd be this one over here on the right side, and the markets would go down, right? The S&P, the NASDAQ, all that. If the projection after Jackson Hole is that they're going to cut, then they'll put a new bar on here that says 500-525. But as you can see, there's really no anticipation of a cut for September. And for November, also no cut, which gets us into December, a very minor possibility of a cut, but it's a very low key. I think one of the biggest names that are up this morning is one of the FANG names, Tesla. But really, as you're going to see when we go through all this morning, just about everything is up this morning. So we didn't get that alpha protocol last week, but that's all right. You know, it's not supposed to come around every day. All right, so we're looking at a weekly chart here on the right side. You can see that green line, which is my 20-period moving average. We didn't quite get there, but we call it a bounce anyways, right? We give it the nod that it bounced the 20. And the reason we do that is, you know, there's so many different moving averages. There's triangular moving average, whole moving average, self-adjusting moving averages, simple, exponential, triple. So, you know, somewhere in there was a moving average that it hit. We don't look at those as support or resistance or anything like that anyways, but we just give it the nod. So we tapped that 20, but we're still underneath the 10-week, and that's a big deal. Just being underneath it carries a lot of weight. You know, whether or not we're moving back towards it or away from it is an entirely different discussion. You see the volume this morning is really light compared to what we had saw a lot last week. We're sitting at 84. You know, I'd say Friday was 122, last Thursday was 96,000, Wednesday 90,000, and Tuesday at 147,000. So sitting at only 84 today feels a little light, but really it's not that bad. If we get below 75, we'd want to go out and start taking a look at why it's so low. And generally, when you do have that situation, what I found is usually a nation is closed for a banking holiday or something like that. So, you know, take Europe off the table and all of their trading for an example, and suddenly you can account for the light volume. That's usually what it is when it comes in light. A good website for that is tradinghours.com. It'll show you the indexes from around the world at when they should open, when they should close, and if they have any holidays. 10-day, 30-minute volume profile. You can see this classic, beautiful inverse head and shoulders now that we're on the 30-minute. If we were to plot that out and measure it, just a basic candle analysis, right? What they tell you, measure from the shoulder to the head, or you know, where the neckline break is, either one of those, and then project that upwards 50% and 100%. Now, if you don't have these fancy little drawing tools like the quadrant line that I'm using here, which does that 50% and the 100%, if you don't have that, you can just draw a box. Nearly any charting platform that allows you to draw will let you do a box, and you can just copy the box and set it up there just like that. So we're really close to the 50% mark. That's all that it owes us. It doesn't owe us 100% of the move. Just generally speaking, if we make 50, a lot of times we can make 100. But at the moment, the 50% level, which happens to also be a cog line, that's the upside target. And as you can see, when we look left, it kind of ties in with this previous price action back here, right? So it's always nice to see when we lay out our measurements that it lines up with other pivot points. Kind of shows that you're in the right area, right? Your work should validate other work. And when it doesn't, it should stand out as a warning that something's wrong. Relatively shallow when we look left at the profile. We made it through one of the higher volume nodes. Now we've got another area to struggle with around that 4420. We should move, relatively easy in the shallow areas. We've seen how we did that last week. But then we're also very likely going to have a hard time getting through the areas where the shelf begins to build out. If we can get through that 4420, then we're very likely going to go ahead and take out that point of control around the 4490 area. But we got to get there, right? It's kind of the main takeaway. We just got to get there. We're not going to lose any of this volume across the top until Friday morning. So unless we run up there between now and Friday, this volume profile isn't going to narrow at all. It's going to stay this width or this distance. Five-day, 5-minute call, marking out the 5x5. So on Friday, you can see how we interacted with both of these VPOC levels. We're going to end up taking them off this morning. I left them on just so we could discuss it for a moment. We tagged one of them in the pre-market, tagged the other one in the RTH session, and then later in the day, we tagged it again. So, these aren't support and resistance, but they are areas of concern. They're areas where you want to watch price closely and, look for signs that it's interacting at that level. It's a good flip point, right? Or at least kind of above below levels. They make really great first touch plays. We come down and tag it for the first time. Usually you can go the opposite direction for a small trade. It's not like a reversal on the day, some sort of V bottom where we run all the way back in the other direction. But for a inverse play, first touch play, running say a 2-to-1 or a 3-to-1 risk reward usually works out pretty good. Either way, we don't have a VPOC from Friday to carry forward because price has already gone through that area multiple times now this morning. So all we need to do is take these old ones off, but we don't need to add a new one. We do have a classic bull flag right now, nearly textbook in its design. And you can see the move through the kill zone, which is from 2 to 4 in the morning. And it didn't try to close the gap. It's something that I tend to pay attention to quite a bit because this is where I trade, usually is between 5 and 7. And in that window of time, what we often do is revert back to where we were at 2 o'clock in the morning. It's like we closed this gap, but not today. Today we just continued to expand farther away from the gap. And although now we're starting to get a few lower lows, and we at the moment are printing a lower high, it is holding this range, right? So we got to get out of that to really see what we're going to do next. The anticipation, at least for the moment, is the same as last Friday, that we're going to continue to go up, at least in the short term, to kind of spend a little bit of the energy that we picked up in the move down. So, if you were watching RSI Laguerre and looking at energy, we really didn't burn that much energy in this move lower. In fact, it seemed more like we were collecting or building energy in this move lower. And now it's ready to spend it. If this is a pullback before continuing to go lower, then it really needs to stay below 44 33.88. We call it 44.35 just for a nice round number, right? To stay below that. If it gets above that and closes above it on a weekly time frame, then the argument can be made that we're maybe not just pulling back to go lower, and instead maybe we're pulling back or turning back to go to the upside again, right? So that's our line in the sand at the moment, which is a long ways off because we're using that weekly chart. So I'd say we want to make a couple more, right? Just kind of lay out some levels to provide maybe some depth perception. All right, so we got the weekly one. Let's go ahead and get a daily one. And we're there. 44.07 and a tick. All right, so looking at that inverse head and shoulders that we had talked about earlier. %100% was at 44.30. And of course, we already got cog line levels, so we don't necessarily need to mark out the 50% measured move. You can see we are underneath the 10 and the 20 and the 50 on the daily, with the 20 still holding above the 50, but the 10 underneath the 20. I really like what Tom Bowley had laid out when it comes to why we are underneath the 50, but still treating the market as if it's still bullish. Basically, his analysis was that we moved 10% in like 2 months, and the normal S&P movement on a year is 10%, and that's been true over like the last 70 years. So when we moved 10% in 2 months, it changed the curve on that 50 and started to bring it up really fast. Well, of course, the 50 doesn't change, on a dime. So when we topped out and dropped back down, we were able to cut through the 50. Normally, when we're under the 50, that's a significant bearish signal, but the market's not reading it that way this time. If we look at the MACD, though, we'll just use it on the daily here for a minute. The primary line is that blue line, or the cyan line. That's MACD. The gold line is a 9-period moving average of that MACD line. When MACD is on top and we're above 0, we say the primary trend is bullish and the secondary trend is bullish. When MACD crosses through the average line, then the primary trend is bullish, the secondary trend is bearish. And if we get below zero, now the primary trend is bearish, the secondary trend is bearish. And that's where we're at right now, at least on the daily. But again, these tools can mislead after such a significant move in 2 months, right? I like how stock charts, or maybe it's Investors Business Daily, often lays out the argument of a broken chart, right? Because we can't really do analysis on a chart that goes parabolic or starts to have big gaps and does things like that, right? You got to wait for the chart to heal, because analysis is nothing more than looking at what has happened before and making some assumptions about what we could see in the future based on it. Well, that requires nice, clean price action. So when you start getting parabolic moves and big gaps, then it kind of just throws all the analysis right out the window, and you have to wait for the market to clean up and heal itself. All right, we got the weekly expected move here, and we did close outside of the box last week, which shouldn't have been a surprise to anybody. This week's range is only a fraction bigger than last week's range, so they're not really pricing in much volatility for this week. It goes to the narrative that the sell-off that we saw was really calm, controlled, organized, and that we're very likely going to turn around and begin working our way back up. We are still above that anchored VWAP, and at the moment, at least, we have a double bottom, but I don't like it, right? Double bottoms are supposed to be a bear trap, and it needs to go down enough to actually convince the bears so that we can trap them. And that would, all we did there is just kind of wick down through the zone and came back up again. That's not much of a trap, right? Where's the cheese? You gotta entice them to come in there and get it. So I don't think that was very much of a trap. We'll see. There is some concern about what's going on in the dollar and US dollar Japan and the 10-year. So bonds are still falling. We're below 118 now. It's getting really close to oh dang levels. The Dixie is down on the day and continuing to press lower, while the 10-year is in this topping pattern and really threatening to break out higher. That's not what we've had lately, right? So this is a big change of pace. And I just got to stress a lot of caution. When these things aren't lining up and they're not doing what they should do, it doesn't mean that you're reading it wrong. It just means that you don't want to read it. You don't want to use it, right? So normally we'd say if the 10-year is going up, you should be expecting weakness in the S&P and finding new places to take a short. Obviously, that's not true this morning. And when the Dixie or the DXY is going down, then we should anticipate, you know, the S&P could go higher and we'd be looking for long trades. And we are getting that this morning. So it's just not doing what it's supposed to do. And you want to recognize that and own it, right? Just approach with caution. Don't, I don't know, say reduce your position size and, try to take profits a little sooner. Be a little more aware of how many trades you're taking. Try to get a day done and just GTFO, right? All right, so we got US dollar Japan here on the daily in blue, and in the weekly with the black background on the right side. You can see, looking at the weekly, what we really need to focus on is the previous week's high. It's 146.55. We're already through the 50% mark from last week. So that's not even an issue at this point, other than maybe keeping it. And US dollar Japan is absolutely worth keeping your eye on. If this continues to threaten those highs, they're going to start looking at more intervention tactics, and that is going to directly affect the 10-year. So we want to continue to watch US dollar Japan and see if it's going to calm down or not. No fast moves, right? Then we've got the Dixie, or the DXY. It's a pretty steep move since June, or excuse me, since July. That run up from 99.5 to 103.5. I know that might not sound like it went very far, but for the Dixie, that's a heck of a move. So we did get up here to the top where we got a zone of interest, and so far that held as a rejection. If we break through it, it's very likely we're going to go to that 104.75 area next, right? That would just be a logical leg up to the next area. But so far, the rejection is holding. Got a voodoo line at 103. So if we can get through that, then we'll start focusing on 102.5. And it should help with those crude names. Let's try USO. Yeah, so the dollar continuing to fade off like that. These should be down. Right, so you can see on the left side, I've got USO. We are inside day breakout to the upside at around 73.70. And then on the right chart, I've got the Dixie, which is inside day breakout to the downside and really threatening Thursday's lows. So if we continue to see that weakness in the Dixie, we can, maybe lean a little bit into those long plays in energy. Chevron, maybe some ETFs like XOP. Now, generally, if you've got energy moving up, you want to check steel. Maybe not X because of that whole merger buyout thing, but maybe something like Newmont. This morning, the EVs are doing the most. They're up 2.7%. So things like Tesla, Ride, Lee. Well, that's not up very much. Lee just ain't getting it done. Let's see, Neo. Nikola. Whoa, not Nikola. All right, so we got a little bit of a divergence here. Nikola is headed straight down. Debt offering. Okay, well, that explains why that one's headed down. XPEV. So most of your EVs are doing good then, not all of them. I would tiptoe around Nikola. Behind the EVs, we've got Cyber. I believe I have Hack. And what was my other one? CYBR, Cyber. Yeah, that makes sense. So those are the two ETFs that make up that product. Then we've got crypto also up this morning. Riot, Mara, Coin, those kind of. Riot's not up much. Mara too, not really impressive. And Coin. So I mean, yeah, they're up a little bit, but they really seem like they're stalled. They all have the same pattern that they popped up, and they've just been kind of holding the range. I would argue trending a little lower throughout the overnight this morning. And then the pot stocks, ACB, Cron, CGC, Tilray. Not really impressive. The things that are not up very much this morning, or that are down, the China ADRs, BABA, Baidu, JD, PDD, steel names, the airlines, financials, refiners, and communications. They're not doing too good this morning. Oh, come on, Thinkorswim. There you go. You can do it. So in here, it's showing a lot of the China stuff is down. KWeb, MCHI, which is the iShares China ETF. And then, you know, like emerging markets and then bonds are down this morning. All right, Microsoft is up to 318.40. It closed at 316.40. Just doing a little rounding there to make it easier. So we got like a $2 move already this morning in Microsoft. This is a TRB setup on all time frames, from the weekly, the daily, even the hourly at this point. Notice the candle down here is red, but it's hollow, as opposed to these others, which are red but solid. When it's red and hollow, that means it closed higher than it opened, but it closed lower than the previous close. What we want to focus on is 50% of yesterday, which is 319. It's still over our head. We got to get through that level. And if we can get through 319, then we target 322. And we would have to get all the way to that point just to begin to see the TRB setup begin, right? We got to get at least that far. So, today, just looking at it from one single day, I wouldn't expect the TRB. I would really want to use today to prime the market for that TRB. So maybe be watching Microsoft this week for the setup. The reason that a TRB play is so good is because it's where you have the opportunity to perhaps catch one of these really big candles. Now, this candle's the earnings, but still, the TRB very often generates a candle 3 or 4 times greater than the average candles around it. So it's a phenomenal opportunity when you can catch it. It's worth the wait to see it get set up correctly. For this morning, I had a couple people asking over the weekend if I wanted to go long in the fangs, believing that we're done with this pullback, how would I do it? And at this point, I would take at the money put spreads, right? Put credit spreads. That'll keep you in a 1-to-1 risk reward ratio. They're much easier to defend. They don't lose as fast, so that if you're wrong and we do start to fall back down, you can just close it with a minor loss and move on to your next trade. But if you go far out of the money and put on a put credit spread, if you're wrong and we start going the other direction, even a small amount, your trade is going to already be taking significant losses. So you could look at putting on a put credit spread in Microsoft at the money. Try to get half the width of your spread in the credit, right? If it's $5 wide, you want it about $2.50 in credit. All right, we got Apple, which turned around last week on Friday, had that nice up move. Couldn't get through that 50%. This morning, we're there, 175.47, and the line in the sand is 175.49. So we're just continuing from where we closed Friday. It's all the way up to this point. On Apple, it's a little bit of a better setup for a long trade. It's still a TRB that hasn't formed yet. It needs to, like get way up here to even begin the TRB. But we're sitting around that 175.50. What we could see as we come into the open is a little bit of a pullback to Friday's close, which makes a nice springboard and nice bounce to the upside, right? That's the kind of play. If it's going to find support, that's very likely where it's going to find it, right? So we want to focus on that. Think of the continuation from Friday, where it closed Thursday here and opened Friday, gapped down, and then began to run back up. So Since it didn't even get to that 50% on Friday, we haven't failed because we never got there to fail, and it's still holding the line. This doesn't owe us a pullback to close this gap. It could just open this morning and continue to run, but it would be a better setup if it does fade back and give us that bounce, and then we can run it, right? With that in mind, the target would be 177.5. And if we can get above that, it should trigger into some of these stops from back here, give us a little lift, and we'll start looking for the TRB. But we really don't want that TRB today, right? We want to prime for it today and then have just a big blowout candle Tuesday or Wednesday or something like that. And it'd be the same thing here if you wanted to go long a put credit spread at the money. You could try to do the call. You know, someone was asking about an out of the money call, maybe something kind of cheap. You could, but you got to recognize if they strip the volatility out of this thing, out of all of these FANG names, then as we rise, they're going to be ripping that volatility out. And volatility is value or cost, right? I don't want to use the word value, cost. So you want that call to get more expensive so that when you sell it, you make some money, right? You bought it for $1, you sold it for $2. Yay, you made $1. But if it's losing money from this volatility crush and they're going to come in and crush the heck out of it, then that long call that you buy, it'll still make money if we go up, but it's going to be constantly handicapped by the anticipation of a significant volatility reduction. There's the normal volatility that we see getting taken out on a day-to-day basis. And then there's when they basically come in volatility crush, right? Vol crush. I think they're going to vol crush those FANGs and the indexes if we do begin to rally out, which is why the long call by itself isn't really such a good idea for a short-term trade. If you do want to use the call side, buy a call debit spread. That way you can at least try to neutralize as much as possible the volatility crush that's likely coming. And you can see in Apple, they're $2.50 wide strikes. We need some pricing this morning. These are just ugly. None of those look good. Can't trust any pre-market data when it comes to options like this, right? Unless they're options that are trading 24 hours, you don't want to trust any of the data that you see in here. Not until we get to the open anyways. All right, Amazon is also up this morning. It's looking very similar to the setup that we have in Microsoft. We closed at 133.22 and we're at 134.40. Which means we're inside day breakout on Amazon. That gives you 2 levels of support for a long trade. As we come into the open, we're sitting somewhere up here. We want to see if it falls back, catches support, and then runs, or if it breaks the first support, maybe it catches the second one and runs. Of course, there is also the scenario that we come into the open and it just dumps, or that we come into the open and it just runs and never pulls back at all. 50% of Thursday's level is 134.80. It's going to be a significant level to keep your eye on. And then of course, doing any kind of work on the weekly, anything that you could get from the weekly that would provide some value. $136.21. That's going to be a difficult level to get through. The 10-week held on Amazon just beautifully. I mean, if you were going to describe, a textbook bounce on the 10, that's it right there. So now we just got to see how it follows through. All of this on Amazon, by the way, just to keep perspective on this earnings week that it had, because that's still the dominant candle. Everything is inside that week, which isn't really exciting. It's IX10, but it's so big that it's like, whatever. We wouldn't even try to trade that IX10. And Amazon is still bullish in the big picture. All right, same thing with Meta. Netflix is actually looking pretty good. It's underneath that 10-week. So, that's going to be a line in the sand that needs to be dealt with. But we are up this morning, as we would expect, in line with all the others. Don't get me wrong. The tech looks good this morning for like a relief bounce, maybe a little bit of mean reversion sort of thing, but they're already up, right? A lot of them are already up, maybe a little more than I would want, especially when their options are so expensive. It might be one of those days where finance is the better play. Bank of America, for example, is up a little bit this morning. It's a $30 stock. It usually has, liquid options with a reasonable bid-ask spread and, 50-cent wide strikes. So Bank of America is not looking that bad of a choice. You can see it's the same pattern that we've been dealing with on everything else, basically. It's just not down. It's not up this morning per se as much as the others. $30 is the line in the sand. It's the 10-week. We're under the 10. We're under the 50. This is a picture of an unhealthy market. But for a day trade, right, or even for a trade on the week, none of that matters. Beautiful TRB setup in Wells Fargo. I mean, it doesn't get any cleaner than that. Now we just got to get it, right? We need the follow through day, or in this case, the follow through week. Wells Fargo is up this morning, but only slightly up. And that is a bullish engulfing candle, but barely, right? I mean, barely from last week. So a couple of things that I don't like about this is how far off of the high we closed. And the IX10. This is a pretty ugly IX10. But, I mean, even the rejection happened at 111, right where it should. So we need the follow through. If we can get above call it 42.75, then we should be able to maybe start working our way back up through these other levels. It's got a long ways to go. We're certainly not a long-term trade. Not yet. Yeah, their options aren't as good as the Bank of America's, but still, it's not bad. Be careful on those financials because some of them, you would think look good, like Morgan Stanley, but they're not, right? They're pretty nasty options when you go in and start gauging them. Morgan Stanley, Goldman Sachs. Yeah, look at those. That's just trash. Complete and utter trash, right? So just leave those alone. Don't even mess with them. Citigroup. All right, well, okay, maybe Citi's not too bad. Definitely the sisters, Morgan Stanley and Goldman Sachs, leave those two alone. Their options are trash. If we do get a breakout in BABA above, say, 88.5, then we want to target that gap close 90. It's not bad. Everybody, be careful. Have a good week. Watch the clock. And, just one more note, I'll say it again, be really careful with this 10-year bond dollar situation, right? When it's broke, just back away from it. Don't even bother trying to use it. Keep your eye on it, see if it resyncs, but otherwise just back away. I'll see y'all tomorrow.